Happy Friday and welcome everyone to this class. I am Rachel Dashiell, Senior Manager of Trading Services and your host just for today for our Advanced Charting Techniques class. Now I'm excited for what we are having in store for you today, which is going to be trading and interpreting the directional movement index indicators. So definitely stay tuned for the rest of the class today. Please feel free to chat in your questions, comments, requests during the session. We have Mike Fairborn in the chat, so chat in those. He'll be helping us out throughout the session today. And please give us both a follow on X. I am Rachel-CS. Mike is Mike Fairborn CS. He'll put our handles in the chat there. We post a lot of charts, a lot of different updates on there for you. So please also like this video and subscribe to our Trader Talks on Schwab coaching. Now, before we get started, let's hit some of those important disclosures here. So options carry a high level of risk and are not suitable for all investors. The information that we're going to cover today is for general and informational purposes only, should not be considered any type of recommendation or advice. And we're going to cover the paperMoney application. Keep in mind that there are some differences between paper and live trading. Now, for our agenda today, we are going to cover, well, first going to start with a market overview. Then we're going to cover how to implement technical patterns into our trading. And we're also going to discuss the pros and cons of technical indicators. So we're going to learn about that one specifically, the DMI. And then we're going to look at examples on charts and place an example trade. So let's dive in here and get started with our little market overview here. So obviously the last couple days we have reclaimed that 50-day moving average here. Definitely quite a bit of a short-term rally that we have here, and that 50-day moving average is going to act as that near-term support here. So a lot of traders will keep their eyes right around that 67.60 or so, and then that entire gap ledge that we had from earlier this week really becomes that entire area of longer term support here. So that 200-day is right in the mix there. That's right around 66.60. So those are going to be definitely some areas to watch. Now, I think we should bring up rates as well. So rates, we are seeing a little bit of a support retest, or maybe even a failed breakdown here in the 10-year yields, where we had this resistance level for quite some time. We had that breakout, we had a little bit of a retest, we broke through it. Now we're climbing our way back up above that level of old resistance, now possibly new support. So I think there may be a lot of eyes on some of this, a lot of the information that comes out, and especially what we're seeing in the inner markets as well. So a couple charts to kind of kick us off here. Now, we talked about how we're going to focus on the directional movement index. And so I will give you guys basically a rundown of what the directional movement index is, how we can use it to interpret trend and trading signals. We'll run through a scan of essentially how to identify these setups, and then we'll find an example that essentially gives us this setup, and we'll place an options trade based off of that. So I'm excited to show you guys this. So I'm going to get rid of these moving averages here, and let's just talk about what this indicator that we see on the bottom here. So it's called the DMI, or directional movement index. And essentially what this is it is a trend indicator that's going to compare the current trading range compared to the range on the previous day to essentially measure trend. And I'm going to show you four different kind of setups that it uses in its calculation. So I'm going to pull open my marker here so you guys can see this, and I'm going to show you a couple different things. Okay, so let's say this is one candle from the previous day, and then we had another candle that was a little bit lower. Okay, so this is one scenario. Now let's say we have one candle here that traded lower, And then we have another candle that moved higher. I'm just kind of setting the stage for you guys here so you guys can see it. And then we have an inside bar, maybe a big candle with an inside bar that's following it, that's where its trading range takes up the entire inside of that previous candle. And then you have an outside bar or an outside day, which is a tiny candle followed by a larger candle that engulfs the previous candle's price action. Okay, I know, very messy, very messy drawing of these candles, but I wanted to put these side by side to really break down what this indicator and how it's built, and how it's going to assess trends. So essentially, it takes a positive directional movement, you have negative directional movement, and then you have the average directional movement as well. So to kind of get the first line, which is that blue line that you see here, the positive directional movement, this indicator is going to look for scenarios where you have this scenario. So it's going to take essentially the difference between the top of this candle and the top of this candle, and that gives us directional movement, okay? Now, if we're looking for negative directional movement, we're going to have this scenario, and we're actually going to take the lows of the candle and compare those, and that's going to give us our negative directional movement because the price of the stock or the index, whatever it is that we're using for that indicator, is trading down on that day. So it's making a lower low. Now, if you have a scenario like this where you have that entire following day trading in the previous day's range, you're going to get no reading on the directional movement indicator. So keep that in mind. And then the last one here that you have where you have an outside day, it is essentially going to take the difference between this high and this low right here, and this low and this low, or I guess this high and this high, and this low and this low, and it's going to see whichever one of those is larger, and that becomes the directional movement. So if this one is larger, you're going to have essentially positive directional movement. If this one is larger, the reading is going to give it a negative directional movement reading, okay? So essentially, this is kind of how you're getting to some of these indicators that you're seeing below. So again, the blue line is your positive directional movement, comparing that trend, and then the yellow line that you see there is going to be that negative directional movement. Now, you're also going to have that third line that you see there, which is the red one, and that is our average directional movement. So what that essentially does is it takes a 14-day average. So it's going to take a 14-day average true range and essentially just create an average of that movement there. So all of these three indicators that you're getting, obviously they have a more complex calculation than what I'm showing you here, but these are just kind of the basics of how that indicator comes to its outputs. These are all going to tell us different things about the direction of the trend. So let's break this down a little bit more. I'm going to get rid of all of these drawings on the page, and let's just see. Okay, we're going to get rid of all of my drawings there. Okay. So now that we've talked a little bit about just kind of how to calculate it, how you get to these values, let's talk about how to decipher trend. Now, obviously, the number one thing that we always look at is price. All of these indicators that you're ever going to see, that you're ever going to use, are just derivatives of price, calculations of price. So price is the number one indicator. Always, always, always keep that in mind. But indicators like this can help us identify the strength of the trend, turning points, possibly when we should close out our trending positions. So that's why this one is getting me excited today to kind of talk more about it. So let's talk about one of the first ways to interpret this. Now, when one directional movement line is above another, that's going to tell you that the trend is in that direction. So see how this negative directional movement line, this this yellow line here, see how that is still above the positive directional movement line. So notice how you haven't had a cross quite yet. Those indicators are getting pretty close to crossing, but you haven't seen that cross of directional movement or positive directional movement quite yet, which tells us that based off of the ranges that we're seeing, it's not necessarily in an uptrend quite yet. So this tells us that the trend is still down in this case for the longer term. Now, the second kind of way to interpret some of these signals is looking at these crosses. So number one, first thing we want to look at is where those lines are compared to each other. So we're in a negative directional movement environment right now, but we also want to look for when these cross and how they cross. So the second thing we're going to look for is these minor little crosses like this, kind of where you see this here. I'm going to zoom in a little bit so you guys can see it a little bit better. See how the blue line or the positive directional movement line crossed above the yellow line, which is the negative directional movement line. And then just a couple days later, it crossed back down below it. So almost creating like a little bit of a whipsaw in the indicator. That's going to tell us a pretty powerful signal about the trend in that case. So if you have a signal like that, it's going to tell you that that previous trend is going to continue. So whatever the trend was before that little whipsaw means that that trend is going to continue. So if you guys noticed here, the trend before that was negative directional movement. We had that little whipsaw back down, negative directional movement stayed above. So that tells us that that would have been our trend signal that, hey, this directional movement or this trend is still to the downside. And that was actually right near all-time highs in the S&P 500 as well. So look for those little whipsaws, those little tiny crossovers as a signal too, because they mean that the previous trend is still in place. So that's the second one. Now the third one, the third thing that you're going to use with this indicator, oh, and I see a question here. Positive directional movement is the blue line, and negative directional movement is the yellow line. So hopefully that helps, just kind of reminding that. And if you guys ever need to see it on your own, you can right click on the indicator and it'll show you within the edit studies window too, which one is which. Thank you for the question there. So number three, the third way to use this. When you look at divergences, so like a lot of folks look at momentum divergences to see if price is making a higher high, if momentum is confirming that by also making a higher high, or if it's diverging from price where price is making a higher high but momentum is making a lower high. You're going to use this same principle here with looking for divergences in directional movement. So, and I'll show you exactly how to use this one. So if we look, let's say, let's use right here as an example. Okay. If we just isolate the blue, I know it's kind of messy down there because you're seeing three lines, but let's just focus on the blue line right now here. And I'll make it a little bit easier so you guys can see this as well. So I'm going to actually edit this and I'm going to hide both of these just for a moment. Okay. So now you guys can see the blue line, and remember that the blue line is positive directional movement. So notice how as price was making higher highs here, we actually had a lower high being made in the positive directional movement. So that is a signal in itself telling us that, hey, there may be a little bit of slowing momentum to the upside because the directional movement is getting reaching lower highs while price is reaching higher highs. So the acceleration essentially to the upside with that directional movement is slowing. So that is another way that you are going to use this indicator, is looking for divergences there, because that may tell you that that, hey, there may be a possible change in trend coming. Of course, that is just a warning, kind of like a little bit of a yellow flag. Obviously, price is the number one indicator, so price is going to confirm that. So the signal always comes from price itself. Let's put those other lines back on here. Let's show those again. And okay, so now that we have all of these on, we talked about 3 different ways to use it. Now we have 2 more. Okay, so we haven't really talked about the average directional index yet, which is this red line that you see behind here. And so what we're going to do with this is we're actually just going to hide the other 2 and only show the average directional index. Okay. So this is taking that 14 period Wilder's moving average of what you're seeing in both of those directional movements. So it's essentially taking the absolute difference of both of those directional indicators, and it's dividing it by the sum of those directional indicators. So if you have a rising line in the ADX, and this is actually an indicator in itself, it looks exactly like this that you can add onto the chart. It's found under ADX, but this average directional line is essentially, if it's rising, it's going to tell you that there is an increasing tendency for trend to continue in that prevailing direction. So when we had this line start to increase here, as we saw lower highs, lower lows at the start of this trend, you can obviously see that the ADX accelerated to the upside, and that told us, as the ADX was rising, it told us that is the strength in the direction of that underlying trend. So a lot of traders may look for an ADX above 20 to really give a signal of a trending environment in that case. Now, a low or declining ADX, so you have the low ADX here. So we'll use that first as an example. A low ADX indicates a flat or dull trend. So you'll see that a lot of times during consolidations, like you saw here at that top of the S&P 500 quite a few months ago. Or if you see a declining line like this, that is telling you that that trend may be losing momentum. So knowing that about the ADX, the fifth thing that this indicator essentially tells us when we put that together is that we want to look for the peaks and troughs in the ADX, essentially. So when we do see peaks in the ADX, that's often signaling a peak or a trough in prices. And you actually saw that right here almost perfectly. We had that trough in prices, or that low in prices, just as we hit that peak in the ADX and started to roll over. So that's typically used as a trading signal for a trader to start closing their trending position. So if we had a trader that saw this acceleration or saw this negative directional movement to the downside and rode this trend all the way down, if they started to see the ADX arc over a little bit, that would give them a signal to close out that short trend position there. So keep in mind that is a strong, powerful signal in itself. Now, ADX troughs, so kind of like what we saw, let's say here or here. Now, ADX troughs tell us one thing. So they tell us essentially where the markets become a little bit dormant and trendless. So like you saw with this prior consolidation here and this prior consolidation here, but it's telling us that trend is going to begin accelerating in a direction. So when you see these troughs in the ADX of the DMI, you should be watching pretty closely for a breakout in either direction. So this is a lot of information to kind of take in, of 5 different ways on how to use this, but I'm going to show how to essentially show these 2 lines again. I'm just going to click show plot there and show plot there, and we're going to do a review, and then we're going to put this all together. So the 5 ways to interpret the directional movement index. Number 1 is when one directional movement line is above another, which right now the negative directional movement is still above the positive directional movement. So that's one way. Now, the second way is looking for those small little whipsaw crossovers, because that tells us that the previous trend is still in place and is going to continue. The third thing that we're using to interpret it is used as divergences. So we're using this as almost like a momentum type signal for our trend. So we can look for divergences to see if momentum is confirming that trend or if it is not. Then the fourth thing, we're going to look for the movement of the ADX. So we're going to see if the ADX is rising, or we're going to see if the ADX is falling. And then the fifth thing that we're going to look for is ADX peaks or troughs. So that is going to tell us very valuable information about the price trend, whether we need to possibly close our trending position or if we're about to see an acceleration in a direction of the trend. So any questions on that, you guys? Because I know that was a lot of information to really take in for the directional movement index before we kind of put it all together. And I'll keep an eye on the chat there. Okay, so what essentially we are going to look for, I built this little scan that I'll share with you guys, and we'll talk through it on how to look for positive directional movement crossovers, because we know that that is one of our signals that tells us the trend is in a certain direction. And then we're going to use all the different other pieces that we talked about the directional movement index to essentially interpret trend and place a trade. So, and I have Jay Taylor Trade saying, can you repeat 1 and 2? Okay, so we talked about 5 ways to interpret the directional movement index. Number 1 is when one directional movement is above another. That tells us the direction of the trend. And then number 2 is we're going to look for these really small baby crossovers, because that tells us that it's kind of essentially a fake out and that trend is going to persist in the original direction that it was before. So hopefully that helps. And I see another question. Can the DMI be useful in lower time frames or just higher time frames? Yes, it is one of those indicators that will be able to be used in all time frames, no matter what time frame you switch your chart to. So if I move down to a 20-day hourly, that would tell me the same thing. And you can obviously see on the 20-day hourly, we're going to have positive directional movement, obviously, in the driver's seat here. So that's going to change the context a little bit. But again, it's all based off of the trader's time frame. And right now, we're starting with the longest term time frame, and then we're going to piece our way down the track as we formulate this trade. Mary, it's optimal for all of them. It's just essentially based off of your time frame. So if you have a longer term time frame, longer time horizon, you like to stay in trades for months, years, you're going to be wanting to use, I guess I should say months, you're going to want to use the daily chart. If you're looking to swing trade, you're likely going to use intraday charts or an intraday time period there. Okay, moving to the scan. So we're going to look in all listed stocks here. We're putting on some basic filters for price greater than 20, and an average daily volume greater than 2 million. We want to filter out illiquid stocks. We also are looking for a little bit higher level of liquidity because we're hoping that the options will be more liquid as well. And then I put on a couple very basic trend indicators. So price being above the 50-day, price being above the 200-day, can use that as well. And then the last one that I used here was the positive directional index crosses above the negative directional index with 2 bars. So I'll show you real quick on how to build the directional index one. You're going to want to use live trading for this because you don't have the study filters in paperMoney, so keep that in mind. So if you go to study and click the drop down here, go to custom. This is what I looked at when I was building this. So we're going to hit edit. We're going to select study and we're going to look up DMI, so directional movement index. And notice that the plot here says DI plus. Now, if you wanted to switch this a different way, if you were looking for negative directional movement for more of a bearish trade, you could look at the minus DI. But we're going to start with positive directional movement, and we're going to say crosses above. We're going to select study, select DMI again, and select negative directional movement. So we're saying positive directional movement crosses above negative directional movement within 2 bars. So within the last 2 days, okay? And we're gonna hit save. So that's how we got to this one. And I'm gonna click OK. Now, don't worry, if I went through that a little bit fast or went through any of this information a little bit fast, this webcast is being recorded. It will be archived a couple hours after the webcast onto the channel, so you could pause, watch it in half speed, watch it in 1.5 times speed, whatever your pace is. But I know we had a lot to cover today, so I want to make sure we do keep moving. So I'm going to click share scan query with you guys, just so you guys have it. You can import this example scan into your platform. Let's see here. Okay, perfect. Not guaranteed for accuracy, timing, or results. Just have to give that little disclaimer there. Now, let's go with some of the results that we are seeing from this scan. Let's take a look here. Okay, let's go with NVIDIA. We're going to use NVIDIA as an example. We know that it's one of the most liquid stocks out there, and we know that its options are pretty liquid too. So we're going to use that as our example for today. And if we look at NVIDIA, we can see a few different things. Now, we're looking on a longer time frame here with NVIDIA. And we're just going to run through our 5-step process on the DMI and what it's telling us. Because right now we can clearly see that price has gone nowhere for a lot of the last year. So price has really been in this range for quite some time. But the directional movement is giving us a signal. So you can see that just a couple days ago, within the last 2 days, we had the blue line cross above the yellow line. So the positive directional movement moved above the negative directional movement. So that's our number 1 step. That's telling us the trend is up. So we are in an uptrend. Green check there, okay? Now, the second thing, we are going to monitor if within the next couple days we do have that little baby crossover like we've had here, which is going to tell us, hey, wait, pause, the trend is actually going to prevail in the direction that it was in. But it looks like we have enough separation there so far, but again, we're going to monitor that. So that's something that comes in the future. And then another thing, we don't have necessarily any divergences. We essentially have a little bit of confirmation here. So we're actually making higher highs on this blue line, where we're making lower highs in price. So that may be a sign there. We also made higher lows with this indicator as price was making lower lows. So again, momentum in this is confirming. So that's our step 3. Now let's go down to the ADX for step 4 and 5. Okay, so the first thing that we want to see is what direction is the ADX moving? And is it rising or falling? So if we are seeing a falling ADX like we're seeing now, that tells us that that prior trend that we saw when it moved off of the trough here and had these highs and now is turning over, that would be telling us that that trend, that prior trend, is losing momentum. So essentially what that means is this trend that we saw to the downside where we had this bearish channel here, that's telling us that that trend has slowed or reversed from the downside. And then the fifth thing is we're going to look for those ADX peaks and troughs, which we kind of just did a little bit there. But the ADX peaks, like we said before, often signal a peak or a trough in prices. So essentially, right when we hit that peak, if we just put our cursor right on that, that is where we hit a trough or a low in the price there. So that is essentially where we would have gotten that signal as a short seller, or if we had a bearish trade on, that would have given us a signal to start closing out that short position or that bearish position once we saw that curve over. Okay. So this gives us some evidence that tells us that, hey, this trend has reversed and is in an uptrend. So what are we going to do as an options trader? We are going to take a bullish trade in this scenario here. So we're going to piece down to a shorter time frame, as well as talk about a couple other things that we're going to use with our option strategy. So we're going to remove this directional movement indicator because we've already seen that, hey, it's told us a little bit about what the trend is doing. It's given us a little bit of signals here and there. And now we just got to put together our trade, since we've already determined that, hey, this trend is turning around to the upside. We're in an uptrend now. So the first thing we're going to do when we look to integrate an option strategy, we want to see what type of environment we're in from a volatility perspective. So because we want to know that if the volatility environment or the volatility regime is going to favor option buying or option selling. And we know that lower volatility comes with a lower option prices. And as volatility increases, so do the prices of our options. So what do we want to do? Buy low, sell high. Typically, that's where traders will find the sweet spot. If you have higher or elevated levels of volatility, it may tell a trader that we may be looking for option selling strategies. If you're seeing these low or muted levels of implied volatility, it may tell us that it's a more favorable time to be buyers of options in this case, which if we look at the implied volatility down below, we can see that we are at some of the lowest levels that we've seen over the past year, which would be very supportive of us buying options in this case, because we want to buy those options when they are cheaper. And we've already decided that we want to be directional about this. So there's a couple different ways that we could play this one. We could either buy a call option, or we could buy a bull call spread. So a couple different ways that we could do this. I'll show both. So if we move to the trade tab here and we look at NVIDIA, now we noticed that trend had lasted for a couple months. So essentially what we're going to do is we want to ride out this trend with the momentum with it. So we want to give ourselves a little bit of time, maybe a couple months in time, as far as looking out forward to our option. So if we're just going to look at a long option in this case, if we're just going to look to buy a call, we may be looking at the 18th of June 2026, because if we were a buyer of an option, time is always, always, always working against us. And so we want to make sure we don't have so much time decay. And that time decay usually kicks into high gear right around that 30-day mark or so, where you see that theta decay tend to get larger and larger. And you'll see that here in the theta column here. Now, if we're sticking with buying a call option, we may want to look a little bit in the money. So look for an option with a little bit of intrinsic value. We would also have a higher delta in that case, which would tell us we have a higher probability of that option possibly expiring in the money. And also we'd see more of a move on that option when the stock price is moving as well. So if we're going to use one as an example, let us look slightly in the money at this 185 right here. Okay, so this is going for 1510 by 1520. And if we're going to buy a call option, we're going to right click on this. We're going to go buy custom, and we're going to use a stop in this case. Okay. Now, we want to stay within the risk parameters of our account. So this account started with $200,000. We are not going to risk more than 5% of the account. So that gives us about a $10,000 position size or so. So we're going to only take a position that is about 5 contracts. And you can also see here, it'll show you the max loss because the most we are losing is the premium that we are paying. So it's roughly about 7,600 or so. You have unlimited max profit with call options because they essentially can go up to infinity. They probably won't. They'll probably stop at the moon. But in this case, we're going to use 5 contracts here. And we are going to make these good till canceled here on this one. And then we're going to use a 15% trail stop on this option. So that's still going to stay within our risk parameters of our account as well, because we're only wanting to risk essentially about 1%. So if I take stop, change it to trail stop, I can use this trail, and it's essentially just going to trail off of the mark price. I could change it to trailing off the ask, whatever it is, and then I'll change that to a percentage. So I'm going to change that to 15% on the trail. And essentially what that is it's an adaptive stop price. So as the price of the option goes up, our stop will follow it with us. Now, as the price of the option goes down, our stop will stay in place and it'll trigger and either protect our profits or limit our losses. Now, keep in mind that when this triggers off of the mark price, so when the mark or the midpoint price of this option drops by 15%, this will become a market order. So there are some risks there, especially if the stock gaps down overnight. You may not get filled anywhere near the price of your stop. So just keep in mind that stop is just an activation for that market order, and you're not guaranteed a specific price at that point. We are using a market order in this case because the spreads are pretty tight. So we just want to get out immediately in this case. So we are going to send this order, and we're going to hit confirm and send. And we're going to send this in our account there. Okay. Yeah, and I do see a question in the chat from Martin. Earnings release occurs before your expiration date. Yes, great point. So notice that we do have earnings coming up. It is coming up in about a month and a half, so that still gives us a ton of time. Now, we would probably be closing our option quite a bit before that, because we talked about how that time decay tends to really kick into high gear at that 30-day mark. So we are definitely going to close our option out before that earnings within the next month and a half, because we definitely do not want to see a ton of time decay escape from our option. Now, again, we also have that trailing stop set in place, but we can also override that system anytime and say, hey, we do want to get out. We do want to take profit. So keep that in mind. But knowing where the earnings falls right around the corner is definitely very important, because obviously with a lot of earnings announcements, you have a lot of uncertainty. You have implied volatility increasing leading up to that event. And something that a lot of options traders don't want to be doing typically is holding options through that earnings event, because typically after earnings, you have what they call vol crush or volatility crush, where all that volatility, all that uncertainty bakes out of the options, and you're typically left with a much cheaper option than essentially where it was before. So depending on other factors, of course, like the price, time decay, things like that. But Martin, I'm so glad that you brought this up. Now, I had another question. Could I use this for selling puts? Now, selling puts is a bullish to neutral strategy. So a technical setup like this could favor selling puts, but the thing that you have to keep in mind is we are at very, very low levels of volatility. So it's not necessarily the most favorable volatility regime for selling options in this case. It's more favorable for buying options because you have that factor of increases in volatility working in your favor. And we know volatility is mean reverting. So when we have these periods of lower volatility, they tend to switch to periods of higher volatility. So keep that in mind. Now, if you wanted to make this a spread and add on to this, you could leg into a spread or you could have created a debit spread. But essentially, if you wanted to create a little spread here, you could do a 5-wide spread and you could sell, let's say, the 190. So essentially what you're doing if you sell this 190, and I'm going to analyze the trade here on the side and get rid of some of these other things that we have. You can see that, okay, here we go. Okay, so you can see we have a long call right now, but if we sold this 190, we would also have our short call in that would cap us out here. Which essentially this risk profile is not showing that. So I'm sorry, guys. But essentially what we'd be looking to do when we buy the lower strike, sell that higher strike, essentially the most we can make is the credit that we're collecting. So you're going to take the difference from what you paid on that long strike and what you are bringing in when you are selling the short strike, and that is the most that we can make. Now, the most you can lose on that spread, if you decide to do a bull call spread here, the most you can lose is the difference between the strikes, which is $5 minus that net premium that you're collecting. So keep that in mind. That's typically that risk profile of the spread. You are covered up until expiration, but essentially what you'd be looking for the price of the stock to do is move in that bullish direction. You would essentially want the price of the stock to move above 190 in this case. So it's a little bit more aggressive if you want to put that second leg out of the money versus putting it a little bit closer in the money there. You don't necessarily need much of a move to see a profit on that position. So let's see. Okay, couple questions. Was that a bullish NVIDIA trade? Yes, it was. We bought a call, which gives us the right to buy the underlying stock, and a call option is bullish. So you could actually see here in this case, if you are looking at the risk profile, we can see the most we can lose is what we paid for it, and our profit potential goes up as the price of the stock goes up here. So you can see the price of the stock on this axis, the profit potential on the left axis there. Okay, so great question. Let's see. NVIDIA has a good run, so 15% stop loss. Isn't the probability of stopping out greater? We do still want to stay within our risk parameters of our account. So since we are doing 5 contracts, we are having a little bit of a tighter stop. A trader that may want to give it a little bit more leeway may say that they may look for a 20% stop loss, maybe even a 25% stop loss. It's all going to depend on the trader and especially like their risk and position sizing rules. So definitely keep that in mind. Now, the last thing I want to do, since I told you guys we would do this just for a moment, is piece down and look at a price pattern on the lower time frame chart. So if we just look at the lower time frame, typically this is what traders do. So we're in an advanced charting class. We are not only using price, we're not only using trading signals and indicators. We also want to make sure we have a alignment across time frames because probabilities are on your side as a trader. So if you have an alignment across time frames, bullish patterns that show up on the shorter day charts as well, that gives you a lot more conviction going into this trade. And one that we see here is this bullish cup and handle pattern with this cup and this little handle pattern that we see here, which is a bullish reversal type pattern. So I wanted to make sure I shared that as well with you guys. But we learned a lot today. So we learned the 5 different ways to interpret the directional movement index, how to search for some of those trend shifts, and how to position an options trade based off of those trend indicators and the volatility regime. So I want to thank you all for all of your questions, engagement in the chat. Thank you, Mike Fairborn, for helping us out. Please give him a follow on X. He is Mike Fairborn CS. I'm Rachel CS. And please like this video if you found it useful so other traders can find it as well. And then please subscribe to us on Trader Talks Schwab Coaching for more. Thank you, everyone. Hope you have a great weekend and happy Friday.